In a world where economic uncertainty, inflation, and stock market volatility often dominate headlines, investors are increasingly seeking safe havens to preserve their wealth. One traditional but recently resurgent financial instrument is the Treasury bill, T-bill, a short-term debt security issued by the U.S. government. Though they may have been overlooked during years of high stock returns or crypto booms, T-bills are now enjoying renewed interest across all investor categories, from conservative retirees to high net worth individuals to cautious institutions. With yields rising and risk appetites declining, T-bills are back in the spotlight. Here are the top 10 reasons why Treasury bills are gaining popularity again, especially in today's dynamic financial climate. 1. Rising interest rates are making T-bills attractive. One of the most significant reasons behind the resurgence of T-bills is the Federal Reserve's rate hiking cycle. As the Fed continues to combat inflation through aggressive interest rate increases, yields on short-term government securities like T-bills have surged. Unlike bank savings accounts or certificates of deposit, CDs, T-bill rates adjust quickly to reflect current market conditions. This makes them an appealing option for investors looking to capitalize on rising interest income without taking on too much risk. For example, while bank accounts may still offer underwhelming returns, 3-month and 6-month T-bills have crossed yield thresholds above 4% to 5% in many instances, which is significantly better than traditional low-risk alternatives. 2. T-bills are virtually risk-free. Treasury bills are considered one of the safest investments in the world because they are backed by the full faith and credit of the U.S. government. This makes T-bills ideal for risk-averse investors who want to preserve their capital while earning a modest return. With market volatility and geopolitical tension shaking global confidence, the perceived safety of T-bills has only grown more valuable. Unlike corporate bonds or equities, T-bills carry no credit risk, and the U.S. government has never defaulted on its debt. This perception of safety has made T-bills the go-to asset for those looking to park their money temporarily while avoiding market shocks. 3. They offer superior liquidity. Liquidity is a major concern for both individual and institutional investors, and T-bills excel in this regard. Because they are traded in high volumes on the secondary market, T-bills can be easily bought and sold, making them highly liquid. Investors do not need to hold them until maturity if circumstances change. The ease of entry and exit allows T-bills to act as a cash equivalent or a flexible financial buffer, which is particularly important in uncertain times. As interest in cash management strategies grows among both wealth managers and retail investors, T-bills are increasingly seen as an ideal low-risk place to park funds. 4. T-bills provide an inflation hedge when rates rise. Although T-bills don't directly protect against inflation like Treasury inflation-protected securities, TIPS, they become more effective as inflation hedges when interest rates rise in response to inflationary pressures. In essence, rising rates push up the yield on newly issued T-bills, giving investors a way to keep pace with inflation without locking money into long-term securities. While the real return may still be modest, the short maturities and rapidly adjusting rates make T-bills an attractive tool for minimizing inflation's erosive effect on purchasing power, especially compared to long-term fixed-income investments that may lag behind inflation for years. 5. They require no state or local tax payments. T-bills are exempt from state and local taxes, although they are subject to federal income tax. This makes them especially attractive for investors in high-tax states, such as California or New York, where state and municipal taxes can eat into the returns of taxable bonds or savings accounts. The tax benefit of T-bills can translate into a higher after-tax yield than comparable bank products. For tax-conscious investors seeking to maximize efficiency, this edge makes T-bills not only a low-risk choice but a tax-advantaged one too. 6. Ideal for short-term goals and cash reserves. Unlike long-term bonds or stock investments, T-bills have maturities ranging from a few weeks to 1 year, making them perfect for funding short-term goals like an upcoming tuition payment, a down payment on a home, or an emergency fund. Investors don't need to worry about long holding periods or interest rate risks over decades. This short-term structure offers predictability and planning flexibility, which is vital for people who need their money soon but don't want it sitting idle in low-yield savings accounts. In today's uncertain environment, Many investors are prioritizing liquidity plus return, and T-bills deliver both. 7. Digital access and automation through brokerages. Technology has made it easier than ever to invest in Treasury bills. Many online brokerages, such as Fidelity, Schwab, and Vanguard, now allow investors to automatically purchase and reinvest T-bills through user-friendly platforms. The rise of fintech solutions and robo-advisors has also contributed to this ease of access. Gone are the days when only institutional investors or bond traders could comfortably navigate the Treasury market. Now, everyday investors can schedule recurring purchases, manage maturities, and monitor returns, all from their smartphones or desktops. This convenience has led to broader adoption, especially among millennials and Gen Z investors seeking safer investment options. 8. Institutional investors are flocking to safety. Large financial institutions, corporations, and pension funds are also piling into T-bills, reinforcing their popularity. Amid global uncertainty, ranging from supply chain disruptions to geopolitical risks, institutions are shifting assets away from speculative plays and into ultra-safe instruments like Treasury bills. When the smart money begins to prioritize preservation of capital over aggressive growth, retail investors often follow suit. The massive inflows from institutions also improve market depth and liquidity, reinforcing the appeal of T-bills as a reliable place to store wealth during economic storms. 9. Growing skepticism toward volatile markets. The rollercoaster ride of cryptocurrency, tech stocks, and even housing markets in recent years has left many investors with burnout and skepticism. As markets become increasingly volatile, the appetite for safer, more predictable investments like T-bills naturally increases. Treasury bills offer an emotional break from market anxiety. They don't crash, they don't default, and they pay what they promise. For retirees, risk-averse investors, or those burned by meme stock mania or crypto collapses, T-bills feel like a return to fundamentals and provide a psychological sense of control. 10. Useful for laddering and strategic diversification. T-bills are ideal tools for constructing bond ladders, a strategy where you stagger maturity dates to ensure a steady stream of cash flow while minimizing reinvestment risk. You can buy 4-week, 8-week, 13-week, and 26-week T-bills in a cycle, ensuring that you always have funds maturing at regular intervals. This approach is popular among conservative investors and institutions alike. T-bills also serve as a safe core holding within a diversified portfolio, offsetting the risks of equities and longer-duration fixed-income assets. For investors seeking both stability and smart strategy, T-bills offer powerful utility. Treasury bills have reclaimed a well-deserved spot in the spotlight, and it's not just because they're low risk. Their rising yields, tax advantages, liquidity, flexibility, and role in preserving wealth during turbulent times make them increasingly attractive to both everyday investors and financial institutions. In an investing world often dominated by high-risk, high-reward narratives, T-bills remind us of the power of simple, stable, and secure investing. Whether you're building a cash reserve, protecting your capital, or just seeking predictable returns, Treasury bills deserve serious consideration in your investment toolkit. With the right strategy, they can anchor a portfolio that weathers uncertainty and still grows with confidence.